Okay, folks, say it with me now. Tax-free income in perpetuity for the rest of your life. Damn it, a statement even Kevin O'Leary could be proud of. And if you're Canadian, this is the reality of the Canadian Revenue Agency's TFSA, the tax-free savings account that gives you the capability to invest in all of the Canadian conglomerates, from your banks to your telecom providers, or even the likes of Apple and US conglomerates. And I've always said, to simplify your investing journey, pick one thing that you pay every single month, one monthly bill. Let's say it's a phone bill. You're paying your telecom provider $50, $100 a month. You got to ask yourself, how much do I have to buy of that telecom provider's stock for them to pay me enough of a dividend to pay that bill for the rest of my life so I would never have to worry about it again? Well, that's going to be a huge benefit if you're doing it in a TFSA, because all that money you make off that telecom provider will be 100% tax-free. And I'm going to break this down for how I do it, the do's, the don'ts, and everything you're going to need to know. So if that is a conversation you can appreciate, hit that like button, folks, because let's do some transparency here first. If you're brand new to this, what the heck is a TFSA? And then I'll show you my personal TFSA. But basically, from the CRA themselves, which, by the way, if you want to know how much you can put in these accounts, go into Google, type in CRA login, log in with a partner or financial institution you use. It's a little bit of work, security for your reasons. And you can scroll to the bottom left of that page and it'll show you exactly how much you can contribute. It is not the same for everybody, but the TFSA program began in 2009, and it was a way for individuals who are 18 years of age or older and who have a valid social insurance number to set money aside tax-free throughout their lifetime. Contributions to a TFSA are not deductible for income tax purposes. Any amount contributed, as well as any income earned in the account, for example, investment income and capital gains, is generally tax-free even when it is withdrawn. Think about that. You're pulling that money out, doesn't actually hit your income tax bracket, and you're spending and buying things with it 100% tax-free. Damn, that sounds like a dream, right? Now, administrative or other fees in relation to a TFSA and any interest on money borrowed to contribute to a TFSA are not tax deductible either. So basically, let's take a look at my own TFSA, how I've structured this. And again, this will be different for everybody. Not here to offer financial advice, but we will take a look at my investments in this account. So currently, my TFSA is worth $155,952. Again, this is well beyond the contribution limit because I've well over doubled these accounts. To be 100% transparent, not as a humble brag here, but taking a look at the returns, this account's existence since July of 2017, and to date, I've returned 146.81% against the S&P 500, the benchmark that has only returned 71.25%, but that is easy to gloat in a market where a rising tide raises all ship, and I'd like to say I'm a genius, but damn it, over the last 20 years, we've experienced a bull market unlike any time history has ever shown since the stock market's inception. So I'm by no means a genius. Take everything I say with a grain of salt. But these days, being a lot more conservative, not focused on individual investments as much, I've kind of taken the structure of ETFs. So scrolling down and just taking a quick look here, I own the Vanguard FTSE Canadian High Dividend Yield Index ETF. Currently, I've got about $40,000 in here. Now, if you're not aware, these indexes are a much safer way for me to hold the Canadian stocks that I love. And we'll take a look at the dividends they're paying. But this account specifically heavyweights Royal Bank, Toronto Dominion Bank, Enbridge, Bank of Nova Scotia, Bank of Montreal, Canadian Natural Resources, TC Energy, Suncor Energy. There's your Bell Telecom provider. And all of these are yielding fairly high results, because if we take a look at the dividend income, this entire account is paying me, or this ETF specifically is paying me about $1,410 annually, and that's divvied up monthly. I mean, that's a full vacation, right? That's pretty beautiful. And then on the US side of the border here, guys, I always recommend that when you open a TFSA, you say, I want two separate accounts. I want a US dollar account and a Canadian dollar account. US dollars are accepted globally. Maybe you travel to the US. It's always nice having that option, but if you don't tell them you want that option, you might not realize you can actually separate your US dollars and your Canadian dollars, which you can draw against to use as you please. But taking a look, I own VYM, the Vanguard Index Fund, Vanguard High Dividend Yield ETF. So the same thing as VDY, but on the US side of the border. I've got about 26,000 US dollars in that. And same with the S&P 500, which obviously represents the 500 largest companies in the US. I got about $63,000 in there. And we can see, guys, that these are doing relatively okay since I made this shift in these kind of more tumultuous times. But what you want to be aware of first and foremost is you have to understand understand if you're buying US stocks for dividend income, you're still going to get hit with a penalty of a 15% withholding tax. It's just a treaty the Canadian and US government has making money over the border. You're still going to get taxed within this account. But once you get that little bit of tax, you're not taxed on anything else. All capital gains are pretty much tax-free. You don't experience that on Canadian stocks, but the reality is the US economy has grown much faster and has offered much better returns, which is why I'm so heavily focused on the S&P 500, because I really like those cap gains. That's what's really driven this account to the level that it currently sits at. So from the US account perspective, I'm making $1,804 US dollars here, guys, minusing again the 15% withholding, but that's why I focus so much more on growth. The early days, I was buying Apple individually in here and just trying to get more growth prospects as I was much younger, more risk adjusted. But we can see that, you know, with a 1.52% VOO, the current dividend yield, that's not very high, but enough to make $956 US dollars a year, which isn't bad. But to try and get some more compounded dividend growth, because I like reinvesting these back into these indexes, I did buy some VYM, which we talked about, yielding 3.16%, giving me about $847. But from your own personal perspective, maybe you're younger, you're more risk adjusted, you want to pay some bills, you want to see kind of those gains come in and those dividends. Let's use Bell as an example. This is a beautiful example, pretty great performing stock overall if we're looking for yield, because it's paying a 5.81% dividend. So let's use my phone bill as an example. I'm paying about $50 a month. Always recommend buying a phone and paying it off up front, because the telecom providers tend to give you better cell phone plans if you actually own the phone outright. So I'm paying about $50 a month. So that's about what, $600 a year. Well, if I were to put even $10,000 into Bell, I would be making $581 annually. That's almost $600. I mean, that's kind of crazy here off that 5.81% yield. So think about it. $10,000 is a lot of money, but you got to kind of work it in your head that, holy crap, $10,000 would mean I'd never have to pay my phone bill ever again forever. So if you can just come up with 10 grand, use that as the starting point to start pushing yourself to financial independence, because once you've got that done, then you can move over to say, hey, the hydro bill, I'm paying $100, $200 a month in a hydro bill. How much of the utilities would I have to own? You could look at Hydro One. You could look at Algonquin Power and Utility Corp. You could look at utility ETFs that might yield 3 to 4%. And you'd say, hey, man, it wouldn't take much more than maybe 30, 40,000 a year to perpetuate never having to pay for my hydro bill again. This stuff is absolutely beautiful. So let's talk about some of the do's, the don'ts, things that you need to be very aware of and cognizant of in this account so you don't get penalized or screwed. And the first thing is day trading. I know it's everyone's dream to become a day trader and make all this money sitting behind a computer learning a useless skill that has no applicable value in real life. But nonetheless, the TFSA guys, the CRA will slap you upside the head if they see you trading in and out of stocks on a daily basis. It's purely left up to a judge. It's kind of a gray area. And honestly, if you don't make any money, I doubt they'd come after you. But the point of this account is to perpetuate passive income into your retirement. That's how they want you to focus on it. So if you day trade, you will end up having to pay regular income tax on it, because they'll look at it as you working for that capital, right? The other thing you need to be aware of is how you withdraw from this account, because the neat thing is as you make capital gains or dividends, you can draw against them, and whatever you take out, you can actually fully recontribute the following year, discluding whatever the government chooses to allow you to contribute. So on top of your contributions, you can always put back in what you pulled out, which is pretty nice. But this is also a double-edged sword, right? Because if you're focused on high risk investments in a time where high risk isn't doing that well, and you lose money, the contribution room that you were allowed, if you lose that money, it's gone forever, guys. You take losses in there, that contribution room will evaporate. So you need to keep cognizant of that. But I always recommend having a good mix of kind of growth and income. So that way, you know, it's always a balancing act. And I still believe that we are heading into some very good growth periods in the market, but this isn't financial advice. And, you know, past returns do not equal future returns. And, you know, that's how every analyst can be wrong and still have a job. So I'm not going to be an analyst, but I am telling you to start investing today. It will change your life, especially the longer the time horizon you have, whether you're 20 years old or 30 years old or even 40 years old. You have a long time horizon to take advantage of this beautiful, beautiful account. Now, if you have further questions, want to support the channel and everything I'm doing here, you can talk with me one-on-one, pick my brain about TFSAs, RSPs, corporate accounts, starting social media businesses, and anything that's relevant to you, but only as my own opinion, because I do not offer financial advice. Come to therichgang.com, book a one-on-one session with me, guys. It would greatly support my channel, and I think it would be fun to communicate with you guys beyond what's going on between this screen. And you'll also get access to some of my chat groups, so we can continue that conversation in perpetuity for the rest of your life with any questions you may have down the road. But stay cool, damn it, stay awesome, and as always, I look forward to catching you in the next one.